looking at the tech names here and the big gains we've seen over the last few sessions. Brent Thill, of course, Jefferies Analyst. And Brent, today we're talking about Netflix hitting a new high on the back of an upgrade. But of course, yesterday it was Alphabet, it was Apple. What do you think's been driving the gains here? Are these individual stories that we're seeing play out with these stocks, or you think we're sort of seeing a cycling back into the high growth names?
Yeah, I think, we took a little bit of a break earlier in the year, and I think we're now coming back. Obviously, last year was a huge year for tech, given, the digital disruption theme. And I think, this is not going to end. We're clearly in a completely different world, in our opinion, a work from anywhere trend, a world where we're being digitally connected by our devices and by this content. And ultimately, I think this is just lack of exciting growth in other places. Part of it is fund managers, don't want to be underweight. A lot of these stories are, as you highlighted earlier, are making up a big piece of the benchmark, and they can't, if they're underweight Google and Google goes up like it did, this year, up 64% year to date, they don't want to be underweight. I think the other piece is valuation. So in software, we're dealing with multiples at 30 to 50 times revenue. Google's trading at 15 times EBITDA, and these are cheap multiples. They're growing EBITDA faster than that. So that would say historic kind of textbook finance. Like if you can buy a company that's trading below its EBITDA growth, like it's probably a good investment, right? And so Google, it has really benefited. I think some of these stay-at-home stories. Netflix, Amazon have really underperformed given lofty expectations. And look, we are venturing back out into the world. We are doing more. But I think, those stories have been effectively lagging in a big way. And so I think investors are looking at, these kind of stay-at-home names, whether it's Zoom, Amazon, Netflix as 2022 stories, and are looking, later in this year to put more money to work back into that sector as the opening trades, right? The Googles, the Facebooks, the Apples have been working better.
Yeah, it's interesting because we saw that big move after Zoom's earnings, and obviously, there's a lot, I guess, kind of signaling maybe some tough comps in keeping that growth rate up. But as Akiko's kind of pointing out, and we heard Jared walk through, with the 10-year back towards 1.3. And expectations ahead. Everyone's, the timeline may have gotten pushed back, but the expectation still rates will be rising eventually here. I wonder how much maybe that delivers a cap to maybe the upside in some of these names if we do see that rotation back towards cyclical.
Yeah, I think, look, that's what kind of ruined the tech party earlier on as rates started to rise. So something to keep an eye on. But ultimately go back to the multi-year journey, right? Did you want to be overweight Google, Facebook, Apple, Microsoft, a number of these names? And the answer is yes. And I don't think the world is changing. I don't think we're going back to the old world and some of these old school industries. I think they're going to matter, but I don't think they're going to matter as much as what's happening in tech. And that's not a self-serving comment because I work in tech. It is a comment that has, driven this for quite some time. And it's been the right way to go. So I believe that this is a continued multi-year shift. And again, we're dealing in internet. We're not dealing with big multiples. We're really not dealing with incredibly large multiples. And I look at there's some great stories, like you look at Zillow in the home market, right? This multiple is contracted as home prices have risen, inventories, shrunk, and you look at the multiple correction. Are they going to be in a better position or worse position to understand digital buyers for homes, in 5 years? And I think they're in a better position. And that's one example, but there's a lot of other examples of companies really disrupting these old school industries that I think, you look at even Chewy, right? I was completely wrong on this stock. And as people adopted pets, they didn't go to Target and Walmart for their dog food. They went to Chewy, and that stock has been a home run over the last 2 years. So I think tech is still going to be the way that many of our investors are going to still be parked overweight. It's been the right call. I think it's still the right call to have, again, select exposure. And we don't think this trade's done.
Brent, you mentioned valuations and what you're watching right now. Where do you see the biggest opportunities on that front? When you think about where things stood last year, some would argue that valuations ran way too high, which led some investors to pull back just a bit. What are you seeing right now that you like?
Yeah, I think, look, there's a divergence right now. We have a lot of software companies trading at, 30 to 50 times revenue, Snowflake at 50 times revenue. It's really hard to make stories work like that at 50 times. It's a great company, but, stocks lagged many of its peers this year because of that multiple. Stories that we like right now, we like Iron Source, tickers IS, below 10. It's a recent SPAC, and just full disclosure, right? SPACs have been traded difficultly, but this is a great story serving the advertising economy for mobile gaming and the application economy. A great team. We think that stock below 10. You have to be patient through the SPAC process, but this is a good story. Vimeo is another story we've highlighted. NVIDIA, VMEO is the ticker, $54 price target. Helping, with the video economy. We really like that story. Recent spin out of IAC, extremely well run. Those are some smaller names. In terms of large cap, we still like Microsoft, Google, Facebook, Adobe. These are great, pillars. Intuit's another story that we've highlighted for many years. It's had 13 straight years of positive returns. And we think the story has been, it's up 47% year to date. People are going to pay their taxes. Small businesses need accounting software to run their back office. So those are a few names that we like in our coverage.
Again, you haven't been wrong here, and being in tech has been, a huge thing for anyone who had really leaned into that trade. So that's definitely been the correct answer for years now. But there is kind of one risk that I guess we haven't talked about as much recently because there hasn't been much progress, and maybe that's the point. But when you look at maybe some of the anti-monopoly rhetoric that we've heard about cracking down on big tech, obviously that's been going on in China. But back here at home, politicians maybe not really raising that many concerns as of late. I mean, I wonder how big that overhang is still in your eyes when we talk about maybe breaking up some of these companies. If there is standouts, maybe that the risk seems higher.
Yeah, regulatory is always going to be a concern, and it's something we treat seriously. But what I've said for basically 2 decades covering tech is ignore it as an investor, which means you use this as an opportunity to invest, right? When you had the Microsoft case in the EU case, right, that the stock, was $30 and Microsoft is now $300, right? So did you want to invest in the face of regulatory overhang, right? Mark Zuckerberg a few years ago sat in front of Congress and the stock was below $150. It's $376. So I think, you go back to the playbook we've had is treat it with respect. The regulators are trying to do their job. And effectively, we think these companies will find a middle ground. They don't want to hurt the end user. They want to help. And if there's something the regulators need, they'll do it. I don't think they're broken up. We don't think there's a case. Again, if I'm wrong, what I've said is that you want me to be wrong, because the sum of the parts in Google being broken up between Waymo, Verily Healthcare, their cloud, you go through all these initiatives, the sum of the parts are better, right, than the existing trading. If Amazon broke up AWS, like if Snowflake trades at 50 times revenue, I'm not sure what AWS would trade at, but it's a big multiple and it's higher than where Amazon's trading today. So if they spun out Amazon AWS because the regulators made them, and I don't think that happens, but if you're hoping I'm wrong, because the stock's going to rip, because the sum of the parts is just better than the whole. So the reality is, I think you use this as an opportunity. Every time there's a regulatory scare, again, how many times has Google had a lawsuit from the government and you're up 64% year to date? Facebook, same thing. Like, you just keep going through the case studies. Like, the playbook has worked.
Hey, if it ain't broke, don't fix it. We don't have a lot of guests who will come on here to kick off the show and I'll just sit there talk, but I could listen to that for hours. Brent Thill here, kicking us off today. Appreciate you coming on, man. You got to come back sometime soon. Be well.